Hello and welcome to the YouTube special edition of Mutual Fund Corner. I'm Vinny Motiwala and today we are diving into the most essential topics for an investor. That is, how should one be building a balanced portfolio? Whether you are starting out or you're a seasoned pro, having a right mix in terms of your asset can make a big difference in weathering the market volatility. While aiming at your long-term growth, what is the strategy you should be following? To discuss that and help you build a balanced portfolio, today we're going to be bringing on our guest. We have Prableen Bajpai, founder at FinFix Research and Analytics, joining in with us. Prableen, thank you so much for joining in with us on the special edition of Mutual Fund Corner. And I'm going to dive right in. Balanced portfolio, right? That's one of the important keys that one should be watching out for when you're building your portfolio. What are the key components that an investor should look at in terms from a balanced portfolio mutual fund view?
Hi, Vinny. Great to be here. I think balanced portfolio is something that we all want because we want to maximize our returns and minimize our risk. And if you're looking in terms of the components which are part of a balanced portfolio, two essential things. So the first is that it is never a one asset portfolio. It has to be diversified across different asset classes. And typically it would be debt and equity, just to put it simply, so that investors can understand. So you have part of your portfolio in equities and part of your portfolio which is balancing the volatility of equity in the fixed income space. So it's a combination of two or more asset classes, number one. And these are investors, who are middle of the road risk takers. So they don't want too much risk in the portfolio. And when we are looking to do that, we have to have the components which can balance each other. And equity, as we know, it's a growth asset and it provides us great growth, but the growth is non-linear and it is, complemented, and what comes along with it is volatility. And to counterbalance that, we have the fixed income, which is going to give us linear growth, but we have more certainty, we have the stability coming from there. And the other asset classes, which can also be part of a balanced portfolio, are gold. And of course, real estate is always one, but broadly it is equity, debt, and gold. And typically a balanced portfolio would not give you returns, or the expectations of returns cannot be very high. So when investors are looking at a robust, balanced portfolio, they also have to understand that not only are you looking to generate decent returns, but those returns, at what level of risk they are coming, that is really important, and we are looking to sort of bring that to a moderate level. So that's how a balanced portfolio broadly is, and I think we'll talk more about it as we proceed.
Absolutely. What's interesting, you spoke about those asset classes, right? Different asset classes, that's going to be a key in terms for a balanced portfolio. So as a term of percentages for the portfolio, what should be allocated to equity funds, debt funds, other asset classes, like you were mentioning gold as well? And how should one be managing those different risk appetites also, which is a key in terms for the balanced portfolio?
Right. So, very moderate, risk investor, risk taker, an investor would want, of course, that the volatility in the portfolio is never too high. And a balanced portfolio typically aims at bringing decent returns, like I mentioned, along with giving us, a level of moderate risk. And an accepted combination of how a balanced portfolio looks like is a 50-50 proportion between debt and equity, or a 60-40 proportion. Now, it's like working out on a diet for yourself. So, because as humans, we have so many different variables working for us. Each in a different age group will have different financial goals, aspirations, income levels, net worth. So it is very hard to, sort of give one precise formula which can work for everybody, but the broader accepted definition of a balanced portfolio works in a 50-50 model or a 60-40 model. And if we go with the 60-40 approach, so let's say that 60% is in equities, which is going to give us about 12% returns, and that 40% is in fixed income, which is going to give us roughly 7% returns. A balanced portfolio with this combination gives us about 10% returns. And that is something these investors who are seeking, moderate level of risk have to be happy with. Now, if you are a slightly aggressive investor, maybe you can go and settle at something like a 70-30 portfolio. And if you are more conservative, you can go down and reverse it, where probably you can have 40% in equities and 60% in fixed income. So for every investor, depending on their own goals, risk appetite and requirements, this proportion would vary. But the standard formula is 50-50 or 60-40.
50-50 or 60-40. But I just want to know, like you were mentioning also, you cannot have one rule for everyone, right? So someone who is younger, maybe in their 20s, they could go for the 7-30 option as well, right? 70% and 30% according to the risk that they can take, because it's easier for them to take the risk at that age.
Absolutely. But Vinny, I'll also beg to differ here that sometimes at a younger age, probably you can have more responsibilities. So, your background and everything, how your financial life is really the deciding factor. So age is a very important component, because we know that we want to take exposure to equity and, work on that compounding. For example, if somebody is starting off at 25 years of age with the 10,000 SIP, that person can create in the next 30 years an SIP, through the SIP, a corpus of about 3.5 crores. And if I'm doing the same at 45, 20 years later, all I can create is about 23 lakhs. So that is how, compounding, the magic of compounding works. And that is why we promote that more towards equities. But at the same time, can a young person always take higher risk? Probably it cannot be a given. So I think the decision for any person in any age group, if you can take the risk, I think 70-30 is a great combination. And I think it can work for anybody who can take that level of risk. I think it can work really well. And if you are in the higher bracket, of risk, if you're a risk taker, then of course about 80-20 can also work for you.
So it depends on the risk that you are ready to take, or the adventure that you are ready to go on. 70-30, 80-20. It's an option that you have depending on your financials also and how you are handling your finance. Prableen, but let's talk about over diversification, because that also seems like a problem sometimes that comes in for investors. So how should one be avoiding over diversification to maintain a balanced portfolio?
So you're right, Vinny. Sometimes we think that we're diversifying, but we are not. So let's say if I go and invest in 4 different large cap funds, or 2 large cap funds and 2 flexi cap funds, which are large cap oriented, maybe in my mind, I feel that, okay, I am diversified across 4 schemes. But the resultant combination would be duplication. My portfolio is primarily in equities, and that too, it would be a large cap centric equity allocation. So it's so important to understand this fine line where, diversification stops to work for you, and then it starts to eroding the returns, and, it doesn't reduce your risk. So we have to be very careful when we are looking at diversification. The main objective is to not only that we are looking to enhance our returns, but actually what we are trying to do is that we are reducing the level of risk in the portfolio. And while doing that, it is important that we are diversifying in, asset classes. So first level of diversification happens at asset class level. So you have equity, you have fixed income, you have gold. And then comes the second layer. So let's say within equities, you have the large caps, and then you have the mid caps, small caps. So within that, you're diversifying. And, you have to go back and review this, let's say every 6 months or at least once a year. Because if you're not reviewing, you can't do the course correction. And you need to be aligned with your objective, the initial objective of your investment and your financial goals. So for that, reviewing becomes important. So, again, going back to example of balanced portfolio. So it's like if you're having 4 different kinds of, let's say in the Indian household, the thali has dal and sabzi, but you can't have 3 different dals in your portfolio, the thali. It's not going to give you anything additional. So, you have to think it from the point of view of having everything in your plate and not having same thing. Otherwise, you result in over diversification.
Absolutely. But, what about sector specific or thematic funds in a balanced portfolio? Should one be looking that, or maybe stick to more of a broader fund? Or is it an individual way of looking at how much is the risk and what you're looking to take?
So ideally here, if we are looking to create a balanced portfolio, we are going with an assumption that the person wants to undertake moderate level of risk. And thematic or sectoral bets, by their very nature, bring in a high level of risk. So within the equity portion, fine, somebody may be wanting to take some thematic exposure, and that can be experimented with. But that little component can definitely increase the overall level of risk in the portfolio. And that is something that the investor needs to be careful about. Also, they need to really calculate. Let's say you're taking a 2% or 3% exposure to something which is very risky. How much is it able to contribute to your overall returns? So sometimes the right allocation can work better rather than having a very small allocation towards something which is very highly risky, and then you're expecting maybe real solid returns there, but it will not make any meaningful contribution to the overall portfolio. So I feel it's better to stick to the broader categories within equity mutual funds, and maybe a small composition of something like a business cycle fund, which is slightly more, let's say, broad based within the thematic category. That can be done.
Probably just one last question is in terms of what you highlighted before as well, right? Keep looking at your portfolio every 6 months. But given that sometimes you see so much of a volatility in the market, how does one go through those phases of economic cycles, bulls, bear market? How is it that one should be looking at this portfolio then?
So many, I think, very important questions. So, theoretically, we say a lot of things, but practically, how do we implement it? So, for example, I am comfortable with a 60-40 proportion of debt and equity. Number one, that I have to keep a track of how much is there in equity, how much is there in fixed income. And when we say fixed income, it's not just your debt funds. It'll also include your fixed deposits. It'll include your PPF, EPF. So number one, that, you have to have a list of everything that you have in your overall portfolio. Once you have that, you can probably set a limit to which you are okay exceeding that. So let's say if I am in the 60-40, initially range, and I say that, okay, I'm comfortable going up to, let's say, 65 or 70% in equity. Beyond that, I will reduce it back. And that can only be done when we're reviewing. So once a year, when you sit down and review your portfolio, if you feel that your equity is, let's say, at 75, that is the time you trim down your exposure a little and add to the fixed income side, and vice versa. So if in case markets are down and your equity portfolio is down to, let's say, 40%, that is the time to add. But it's easier said than done. A lot of us don't do it because there are taxations involved. There is this, generally we tend to just ignore it, that it's okay. And especially in rising markets, our comfort with higher risk just keeps going up. So we feel that, it's giving us good returns, and why should we trim and exit and go back? So it really depends on person to person, but that is how it should be done. That beyond a certain range, you can have that range in your mind of 5 to 10% exceeding the initial set limit. You should trim down and go back to the other asset class.
Okay, Prableen, thank you so much, for joining in with us on this special edition of Mutual Fund Corner for the YouTube edition and helping our viewers understand how they should be building and working on towards a balanced portfolio. Thank you so much for that. And thank you so much, viewers, for tuning in as well.